Hello, hi students. In this video, we will go through Ind AS 116 accounting for leases. So this is also one of the important Ind AS, and you can expect at least one or two sums in the final exam. So in this video, I'll try to cover a few important concepts of accounting for leases and hope that will be helpful for you. And if you need any more support, please feel free to give the comments. Okay, so now for the accounting for leases, so these are the chapter overview which we will cover through this video. One, on the introduction, we will try to see the objective why Ind AS 116 have been framed and what is the scope of Ind AS 116 and what are the exemptions for which Ind AS 116 may not be applied. So we'll go through that. Then second, what is a lease? So we'll go through definition of lease and whether the arrangement or agreement contains a lease. We'll go through few examples, and separation of lease and non-lease components. We'll also go through some examples for this, and contract combinations. Okay, then that will give a bit overview of what lease means. Then some of the key lease concepts we can go through, and so here we'll see when the lease commences and what are the lease terms, lease payments, discount rate, initial direct cost, economic life, and fair value. So basically in Ind AS 116 we will use the discount rate and fair value to determine the present value of the leases, and then we'll have to capitalize the present value of those leases. So we'll go through in detail how the fair value needs to be computed and how the accounting should be done. Okay, in fourth chapter we'll go through accounting for leases in the books of lessee. So here we'll go through how the initial recognition and measurement should be done, and in case of any subsequent measurement how that should be done. There could be some situation where remeasurement would be required. We'll go through a few examples. And lease modifications. So during the lease period, if any modification happens, how the modification should be treated and accounted, we'll go through. And the specific presentation disclosure under Ind AS 116, that also we'll try to cover in this video. Then fifth chapter will talk about accounting for lease in the books of lessor. So here how the lease needs to be classified. So predominantly in the lessor books, the lease might be classified as a finance lease or operating lease. We'll go through in detail. And here the lease modification, how this needs to be accounted in the books of lessor, that also we'll go through. And what are the presentation and disclosure requirement in the books of lessor, we can go through in this chapter. Then finally there could be some subleases and sale and lease back. So those concepts also we'll go through in the last chapter. Okay, so as an introduction, so what is the objective of having Ind AS 116? So Ind AS 116 basically it guides both lessee as well as lessor on the relevant information to be disclosed in the financial statement that faithfully represents those lease transactions. Okay. So prior to Ind AS 116, the long-term leases were not capitalized. So the long-term leases used to be charged to P&L account as and when the rental payment was made. But that was not giving the right picture in the financial statement, because having those long-term lease contract, basically the lessee have the right to use those assets. So ideally there is a long-term commitment, and those things needs to be capitalized. So if you directly charge to P&L account as and when those lease rentals have been paid, then it is not giving in the financial statement a disclosure about the entity's right to own those assets or right to use those assets. So that's not very well captured prior to Ind AS 116. But with the introduction of Ind AS 116, those issues are specifically addressed, and here the lessees are mandated to capitalize the long-term leases. That will give the right presentation of the financial statement. Okay, so now we'll go through the scope of Ind AS 116. So Ind AS 116 shall be applied to all leases. So whatever may be the type of leases, for all leases Ind AS 116 will be applicable, including the right to use assets in a sublease. So even for sublease also Ind AS 116 will be applied. There are some specific exceptions given under Ind AS 116. So only for those specific cases Ind AS 116 may not be applied, and for all the remaining cases the lease will needs to be accounted as per Ind AS 116. Okay, so what are those specific cases where the lease Ind AS 116 will not be applied? We'll go through. So first is lease to explore for use of minerals. So for the lease of minerals, there is a specific Ind AS available, Ind AS 106. So in those cases Ind AS 106 needs to be followed, and there Ind AS 116 will not be applied. Similarly, second situation where the leases of biological assets held by a lessee. So here also we have a specific Ind AS 41 for agriculture. So Ind AS 41 needs to be referred in this type of leases, and Ind AS 116 will not be applied. Then service concession arrangement. So here also Ind AS 115 needs to be referred and not Ind AS 116. Similarly, license for intellectual property granted by a lessor. So here also Ind AS 115 already covers this intellectual property license, and Ind AS 116 will not be applied in those cases. Then the last one, rights held by a lessee under licensing arrangements for such items as motion picture, films, video recording. So for these type of leases also there is a specific Ind AS 38 intangible asset that needs to be followed, and Ind AS 116 will not be applied in those cases. Okay, and finally a lessee but is not required to apply Ind AS 116 to leases of intangible assets other than those described here. So whatever we saw 1 to 5 all are kind of intangible leases, and if there are any other leases that relates to intangible assets, so there also the lessee can take a view that Ind AS 116 may not be applied. It's up to its option. Okay, so if you wanted to apply for those intangible leases, that's well and good, and if you opts not to apply, then that's also fine. Okay, so that's the scope of Ind AS 116. Now we'll go through what are the situations where the Ind AS 116 will not be applied, exemption. So there are two situations. One, it's a short-term leases. For short-term leases, Ind AS 116 will not be applied. Similarly, for low-value assets, Ind AS 116 will not be applied. Okay, we'll go through what is short-term leases and what is low-value leases. Let me make a little bit bigger. Okay, for the short-term leases, we have two conditions that needs to be met. If both these two conditions are met, then for short-term leases, Ind AS 116 will not be applied. Then you can directly charge off to P&L of those lease rentals. Okay, so the first condition for short-term lease is that a short-term lease is a lease that at the commencement date has lease term of 12 months or less. So the lease term should be 12 months or less. So if a lease period is more than 12 months, then Ind AS 116 will be applied, and if a lease term period is less than 12 months, then Ind AS 116 will not be applied. So that's the first condition. And second condition is that a short-term lease does not include an option to purchase the underlying asset. So even if it is short-term lease less than 12 months, at the end of the lease period, if lessee have the option to buy back those assets, then also Ind AS 116 will be applied, even though the lease term is less than 12 months. So these are the two conditions needs to be fulfilled for a lessee not to apply Ind AS 116 for these short-term leases. So just one more additional point. So the exemption can be made by a class of underlying asset. So it need not have to be individual asset. So this exemption can be applied to a class of similar assets. And one more note is that a lease cannot be classified as short-term lease if the lease term is subsequently reduced to less than 12 months. Okay, subsequently reduced to less than 12 months. So initially it's more than 12 months. Later party agreed to change the lease contract and reduce the lease period to 12 months. So in that case also Ind AS 116 will be applied. So here the important point is that what is the lease term at the time of initial contract. So any subsequent amendment will not be matter. So what is the initial contract stays? So if any initial contract lease term is more than 12 months, then Ind AS 116 will be applied. Hope that is clear. Now we'll also go through how the low value assets needs to be identified. So leases for which the underlying asset is of low value. So basically Ind AS 116 is not specifically defining what is the low value. The threshold is not defined. So it can be decided as per the company's policy. So there could be cases where company can opt up to any asset up to rupees 1 lakh may be low value, then Ind AS 116 will not be applied. It goes with the policy of the company, but policy should be reasonable. So they cannot say that a building is a low value. So building value could be run into lakhs and crores. So that they cannot, as a policy, define as a low value. Okay. And to qualify exemption for the low value assets, both these two conditions needs to be satisfied. So the first condition is the lessee can benefit from the use of the underlying assets. So the lessee can benefit from the use of the underlying asset on its own or together with other resources that are readily available to the lessee. So this is the first condition that needs to be met. And second condition is the underlying asset is not highly dependent on or highly interrelated with other assets. So the underlying asset is not highly dependent on or highly interrelated with the other assets. So these are the two conditions needs to be satisfied. So we'll go through a few examples to understand in detail. And the exemption can be made available on lease by lease basis, not on a consolidated basis. Okay, and a general note. So the exemption for lease of low value items intend to capture the leases that are high in volume but low in value. So generally where you have many quantities but each quantity have low value, in those cases the exemption for not accounting Ind AS 116 using low value assets could be feasible. So that's the first comment. And second is, if a lessee subleases an asset, so sublease an asset or expects to sublease an asset, the head lease does not qualify as lease of a low value asset. So the head lease, of course, it will be a high value, and head lease cannot be qualified as a low value and cannot be exempted in case of sublease situations. Okay. So we'll go through a few examples. So first example on the short-term lease. So here scenario A lessee enters into a lease with a 9-month non-cancelable term with an option to extend the lease for four more months. Okay, so initial period is only 9 months and then with an option to extend by another 4 months. So together it could be 13 months, where if you add the 4 months also, then the period exceeds 12 months. So it may not be qualified to account as a short-term lease. Okay, the lease does not have a purchase option. Okay, at the lease commencement date, the lessee is reasonably certain to exercise the extension option because the monthly lease payment during the extension period are significantly below market value. Okay, so which means even at the time of beginning the lease agreement itself, the lessee had the intention to extend the lease for another 4 months. because of the better rental he gets. Okay, so let's see what is the answer. As the lessee is reasonably certain to exercise the extension option, refer section 3.2 of the lease term. So the lease term is greater than 9 months, so totally 13 months, 9 plus 4. Therefore the lessee will not account for the lease as a short term lease. So it's a long term lease, so Ind AS 116 should be applied here. Okay, then we'll go through section B, scenario B. So here assume that the facts as scenario A, except at the lease commencement date, the lessee is not reasonably certain to exercise the extension option because the monthly lease payments during the optional extension period are at what the lessee expects to be market rate, and there are not other factors that would make exercise of the renewal option reasonably certain. So will your answer be different in this case? Yes, the answer will be different in this case because the lease term is less than 12 months, that is only 9 months. Thus the lessee may account for the said lease under the short term lease exemption. It recognizes lease payments as an expense or either on the straight line basis or in either basis which is systematically can represent the situation. Okay, so here at the beginning of the lease there is a clear intention that the lessee will not extend further for the 4 months. So with that estimate, the lease period will be considered as only 9 months and the short term lease exemption would be available here. Okay, then we'll go through one example for the low value asset. So in this example, an entity may lease a car, okay, for use for its business, and the lease includes the use of the tires attached to the car. Okay, to use the tires for their intended purpose, they can only be used with the car, and as such they are dependent on highly interrelated with the car. So you cannot use tire as a standalone, so tire can be used only along with car. So therefore the tires would not qualify for the low value asset exemption. Okay, so the tire may be low value, but since it's interrelated with the usage of car, the low value exemptions cannot be applied in this situation. Okay, so let's move on. So now I'm going into the second chapter. So in this chapter we'll see what is lease, and here we'll see the definition of lease, whether the arrangement contains a lease, and separation of lease and non-lease components, and when a contract needs to be combined, contract combinations. We'll also go through few examples under each of the sub chapters here. Okay, so first, definition of lease. So a contract that conveys right to control the use of an identified asset for a period in exchange of consideration. So this is the definition of lease. So a contract that conveys right, so it should convey the right to use the identified assets for a defined period in exchange of consideration. So these are the conditions needs to be met to qualify as a lease. Okay, then whether an arrangement contains lease. So let's say you have a contract, and then we have to see whether that contract contains the lease terms. Okay, so first question you have to ask, is there an identified asset? So in the contract you have to have the asset identified. If yes, then you can go through the next question. If not, then the contract does not contain a lease. Okay, if no identified asset is specified in the agreement, then it does not contain a lease. Okay, assuming the identified asset is specified in the agreement, then you have to go through the next question. Does the customer have a right to obtain substantially all of the economic benefits from the use of the asset throughout the period of the use? Okay, so this is the next question you have to ask. So the customer should have right to obtain substantially all of the economic benefits from the use of the assets throughout the period of the use. So it is not throughout the period of the life of the asset. It is throughout the period of the lease period. Let's say you have a building and the customer will have the right to use that building for the substantially all the economic benefits during the lease period. Let's say lease period is 5 years. For that 5 years, if the customer have all the right to use the building for substantially all the economic benefits from that building, then it's a lease. Otherwise it's not a lease. Okay, so this condition should be satisfied. If this condition is not satisfied, then again the contract does not contain a lease term. If it's satisfied, then you have to ask the next question. So next question, basically it needs to be mapped both from customer perspective as well as from supplier perspective. So customer, you can also treat that as a lessor, and supplier means lessee. Okay, so the question is, does the customer or the supplier has the right to direct how and for what purpose the asset is used throughout the period of use? So it should be directed. So the customer or supplier has the right to direct how and what purpose the asset is used throughout the period of the lease. So if customer can direct, then you have to ask the next question. If predominant, then whether the customer operates a lease, operates asset, and or designing the asset. If these two are met, then it's a contract contains a lease. If these two are not met, then the contract does not contain a lease. Okay, then let's go through a few more examples under this chapter. So here, asset implicitly specified in a contract. So you have a contract, but the contract, whether it contains or any clauses that can identify an asset. Okay, so that example we'll go through. So here you have customer XYZ enters into a 10-year contract with the supplier ABC for the use of rolling stock specifically designed for customer XYZ. Okay, the rolling stock is designed to transport material used in customer XYZ's production process and is not suitable for use by other customers. The rolling stock is not explicitly specified in the contract. So the rolling stock, it's a keyword, is not explicitly specified in the contract. It's a bit of implicit, but supplier ABC owns only one rolling stock that is suitable for customer XYZ. So even though in the contract it is not very specifically talked about this machinery, since the lease term is between XYZ and ABC, and XYZ does not have any other asset, so he has only this asset, so it implicitly means that the identified asset is this specific equipment. So supplier ABC owns only one rolling stock that is suitable for customer XYZ use. If the rolling stock does not operate properly, the contract requires supplier ABC to repair or replace the rolling stock. So you have to see whether there is an identified asset here. So answer is yes, the said rolling stock is the identified asset, because though the rolling stock is not specifically specified in the contract, example serial number, it is implicitly specified because supplier ABC must use it to fulfill the contract, because supplier ABC has only this asset, and if he has to fulfill this contract, then he has to use this asset. Okay, then we'll move on to the next example. So here asset implicitly specified in a contract. So customer XYZ enter into a 10-year contract with supplier ABC for the use of a car. Okay, so here the car is identified asset. The specification of the car is specified in the contract. The brand name is specified, type is specified, color is specified, options, etc. all are specified. So at the inception of the contract, the car is not yet built. So car is not yet built, but all the specifications have been specified. So whether the identified asset exists or not exist. So even in this case, yes, the said car is an identified asset even though it is not yet built. Though the car cannot be identified at the inception of the contract, it is implicitly specified at the time of the contract, and the same will be made available to customer XYZ when the lease terms are commenced. Okay, so then we'll move on to the another important concept, substantive substitution rights. So this is a very important concept, since without evaluating this condition, the conclusion as to whether there is an identified asset cannot be arrived. So even if an asset is specified, a customer does not have the right to use an identified asset if at inception of the contract a supplier has the substantive right to substitute the asset throughout the period of use. So to conclude whether the supplier has the right to substitute the asset, the following two conditions needs to be met. So these are the two conditions. So first one, the supplier has the practical ability to substitute the alternate assets. So there should be a practical ability. And second, the supplier would benefit economically from the exercise of the right to substitute the asset. So if these two conditions are met, then it's a substantive substitution right is there. Okay, let's see, take some example to understand clearly the substantive substitution right concept. So in scenario A, an electronic data storage provider, who is a supplier, provides services through a centralized data center that involve the use of a specified server. So specified server is available. The supplier maintains many identical server in a single accessible location and determines at inception of the contract that it is permitted to and can easily substitute another server without customer's consent throughout the period of use. Okay, so this is the situation. And further, supplier would benefit economically from substituting an alternative asset, because doing this would allow supplier to optimize the performance of its network at a only nominal cost. In addition, the supplier has made clear that it has negotiated the right of substantive as an important right in the arrangement. So in the agreement itself it is specified, and the substitution right affected the pricing of the arrangement. So this is very clearly a situation where the supplier provides a kind of centralized data server, and even though the asset is identified, server number 10 is specifically identified, but here the crux is that the lessor wanted to have how the data needs to be stored. So that's it. So to which server it has to be stored, that key is not that much key. Okay, so let's see the answer. So here the customer does not have the right to use the identified asset. Okay, so the customer does not have the right to use the identified asset at the inception of the contract. So the supplier has the practical ability to substitute the server. So server can be substituted and would benefit economically from such a substitution. Thus, there is no identified asset. Okay. However, if the customer could really determine whether the supplier has a substantive substitution right, so the customer would presume the substitution right is not a substantive and conclude that there is an identified asset. So it's a bit judgmental. So you'll have to really see case by case and then determine whether the substantive substitution right is there or not. If there, then there is no identified asset. If not there, then there can be identified asset. So maybe in the situation B, you can get more clarity on this. In the situation B, assume the same facts as in scenario A, except that server number 10 is customized. So it's a customized server, and the supplier does not have practical ability to substitute the customized asset throughout the period of use. So it's a customized, and it cannot be without incurring additional cost. The substitution cannot happen. Additionally, it is unclear whether the supplier would benefit economically from doing that substitution. So in that case, there is no substitution rate, so lease accounting should be followed. So the answer is the substitution rate is not a substantive, and server number 10 would be identified as asset because the supplier does not have the practical ability to substitute the asset, and there is no evidence of economic benefit to the supplier for substituting the asset. So here in DS 116 should be applied for the identified asset. Okay, so we'll go through another case. Here identified asset and physically distinct. Okay, so here customer XYZ enters into a 15-year contract with supplier ABC for the right to use the asset, right to use fiber within a fiber optic cable between Mumbai and Pune. Okay, so the contract identified 5 of the cable, 25 fibers for use of customer XYZ. The 5 fibers are dedicated solely to customer XYZ data for the duration of the contract term. Assume that the supplier ABC does not have a substantive substitution right. Okay, so whether there is an identified asset. So here, yes, the said 5 fibers are identified asset because they are physically distinct and explicitly specified in the contract. So there is no confusion here. Done. Okay, we'll go through the next example. So identified asset not physically distinct. So here customer XYZ enters into a 10-year contract with supplier ABC for the right to transport oil from India to Bangladesh through supplier ABC pipeline. The contract provides that customer XYZ will have right to use 95% of pipeline capacity throughout the term of the arrangement. So here, even though the asset is not physically distinct, but there is a substantive right to use 95% of the pipeline capacity. So hence, yes, the capacity portion of the pipeline is an identified asset. Okay, but in the scenario B, it's only 65%. So 65% is not so substantive. So in that case, it is no, the capacity portion of the pipeline is not identified asset. Okay, so let's move on to next example. So here ABC Limited enters into contract with XYZ Limited, which grants ABC Limited exclusive right to use its specific grain storage facility over a 5-year period in the month of May and June. Okay, so even though it is a 5-year period, only the lease will be taken for the specified month, May and June. So during these months, ABC Limited has the right to decide which crops are placed in storage and when to remove them. XYZ Limited provides the loading and unloading services for the warehousing activities. Okay, so here the answer is ABC Limited has the right to control the use of the identified assets during the period of use because they have the power to determine how the warehouse will be used during the contractually defined usage period. The analysis should focus on the right and the economics of the use of the warehouse for the specified usage period, May and June. So during the period of use, ABC Limited has a right to determine how much of the crop to place in storage and the timing of the placing and removing of the crop. It's all decided by ABC Limited. So these rights are more significant to the economics of the use of the asset than loading and unloading the services being performed by XYZ. Therefore, the contract contains a lease for the specified period of term. Okay, we'll go through one more example. So here company M&O enters into a 15-year contract with Power Corporation Company PQR to purchase all of the electricity produced by the new solar farm. So all the electricity produced will be leased out, and PQR owns the solar farm and will receive tax credit resulting from the construction and ownership of the solar farm, and M&O will receive renewable energy credits that accrue from the use of the solar farm. Okay, so who has the right to substantial benefit from the solar farm? So here company M&O has the right to obtain substantially all of the economic benefit from the use of the solar farm over the 15 years. It's because the electricity produced by the farm over the lease term, that is primarily a primary product from the use of the asset that's being held by M&O. And second is the renewable energy credits, the byproduct for the use of the asset. That's also M&O has a right to use those credits. So although PQR receives the economic benefits from the solar farm in the form of tax credit, so these economic benefits relate to ownership of the farm and not use of the solar farm. The tax credit do not relate to use of the solar farm and therefore are not considered in this assessment. Okay, so we'll go through the next example. So probably you can take this as an homework. You can read, and I also given the solution in the bottom. Okay, I'll take you through this example. So here entity A contracts with supplier H to manufacture parts in a facility. So entity A designed the facility and provided its specification. So supplier H owns a facility and the land, and entity A specifies how many parts it needs and when it needs, and parts should be available. Supplier H operates a machinery and makes all the operating decisions, including how and when the parts are to be produced, as long as it meets the contractual requirements to deliver the specified number of the specified number and the specified date. Assuming supplier H cannot substitute the facility and hence is an identified asset. So which party has the right to control the use of the identified asset? So that's the question here. So here entity A wanted to have some specific manufactured quantity by using the premise or the factory facilities of supplier H. So supplier H will provide the factory facility. Probably the factory facility is designed, customized for the requirement of entity A. But once the contract is signed, supplier H will have all the decision power to manufacture and then deliver all the components to entity A. So it's kind of independent supply arrangement. So here we can conclude there is no lease arrangement. It's kind of supply agreement and not a lease. Then let me go to the next example. So here, right to direct the use of an asset. So entity L enters into a 5-year contract with company A ship owner, for the use of the identified ship. And entity L decides whether and what cargo will be transported, and when and to which ports the ship will sail throughout the period of use. So it's a clear case where the ship is leased out, and Ind AS 116 needs to be followed. The contract contains a lease. And you can take this illustration as your homework. Let's go through the next example. Here entity L rents an office building from landlord M for a term of 10 years. The rental contract stipulates that the office is fully furnished and has newly installed and tailored HVAC system. It also requires landlord M to perform all common area maintenance during the term of the arrangement. So entity L makes single monthly rental payment and does not pay for the maintenance separately. So this office building has a useful life of 40 years, and the HVAC system and office furniture will have a useful life of 15 years. So we'll have to identify what are the units of account in the lease. Okay. So here there are 3 components in the arrangement. One, the building asset, that includes office building and HVAC together, and the office furniture and the maintenance agreement. So there are 3 arrangements, 3 components. Okay, so the office building HVAC system are one lease component. So even though it's kind of 2 identified asset, it's one lease component because they cannot function independently of each other. So the HVAC system, so HVAC means heating, ventilation and air conditioning system. So this is already installed into the building. So building and HVAC system are inseparable. So that's why it's a single component. So the HVAC system was designed and tailored specifically to be integrated in the office building and cannot be removed and used in another building without incurring substantial cost. These buildings assets are a lease component because their building assets are a lease component because they are identified assets for which entity L directs the use. Okay, then the next is office furniture. So office furniture is also independently and can be used on its own. It also lease component because it's a group of distinct assets for which NTL direct the use. And the final maintenance agreement is not a lease component because it's a contract for service and not for use of specified asset. Okay, then in the next video I'll try to come up with more examples, and then I'll also try to cover the remaining chapters. So you have the remaining chapter here. So in the next class we'll see more key concepts: when the lease commences, lease terms, how to determine the present value, and then how to do the accounting under lessee books, lessor books, and sublease and sale and lease back. So these things I'll come up with in the next video. Okay, thank you.